All right, here is my ID number for your consideration. 2014-16-73 is my ID number. Okay, good day, John. I, as a professional accountant, I would like to briefly explain and advise you the importance how you could comply with the Internal Revenue Commission as you as one of the shareholder to a foreign contractor. You owns 5% of the share and the foreign contractor owns 95% of the share, and how you could comply, make some adjustment from your profit and loss statement to reconciliation statement. There's some few bit of adjustment to be required. All right. Firstly, let me further discuss and elaborate on those following transactions that was incurred during the financial year. Okay, net profit as per the profit and loss statement of account was 7,100,000 kina. It is an accessible income, and you have to be had disallowable expenses and accessible income, but not included. All right. Therefore, you have some projects been involved. Okay, project X as an accessible income, which will definitely increase the taxable income. Okay, the project Y and project Z was considered and declared as a loss because they made a loss in the financial year, and it will be considered as an exempt income. The loss will be carried forward to the next financial year. Okay, let's proceed to 2. Administrative wages is a disallowable salary wages income. All right. Okay, accessible expenses which will definitely increase the taxable income. All right, 2,100,000 minus 60,000 will give you 2,040,000 kina. We'll add it onto the taxable income. Let's go to 3. Sales of land is an accessible income or capital gain, which is an exempt income. All right, this 5 million capital gain will be definitely increasing the taxable income, and it is an exempt income. All right, let's proceed to 4. John negotiated a higher superannuation rate of 30%, which is disallowable. Okay, it is an unacceptable salary, but 30% is too much. Therefore, we consider 15% superannuation tax. 120,000 multiplied by 15,000 will give you 18,000 kina. This will increase the taxable income, which is disallowable. All right. As per the Section 91 of the Income Tax Act 1959, and also the tax accounted for Section 73 of the Income Tax Act, which covers the treatment of employees' benefits. All right, let's go to 5. Gulfstream received loan is a non-accessible income or disallowable income. Okay, the loan received of 94,200,000 minus 90,500,000 kina will give you 3,700,000 kina. This could not be taxable income. It is foreign exchange loss or unrealized foreign exchange loss. Therefore, Internal Revenue Commission will not consider or will not accept. They will only consider realizable foreign exchange loss. However, any interest or input interest on the loan could need to be considered for tax purposes. All right, let's go to 6. Environmental law fine, which will definitely non-accessible income or exempt income, which will of course decrease the taxable income. Right, let's proceed to 7. management fees. 900,000 kina is allowable, and 85,000 paid to John's wife is disallowable. Therefore, 900,000 multiplied by 2% will give you 18,000, plus 85,000 will give you 103,000 is an accessible or allowable income, which will definitely increase the taxable income. All right, let's go to 8. PMB motor vehicle passage is non-accessible deduction or disallowable, and the depreciation part of the motor vehicle will be considered as allowable. All right, so you have to multiply 80,000 multiplied by 30% will give you 24,000, multiplied by 9 over 12 months, which will give you 18,000 kina, will definitely decrease the taxable income. All right, dividend increase the taxable income, and it's disallowable or accessible income, and it will increase taxable income. In this case, no need to do any adjustment because it is not increased in the net profit. Okay, let's go to 10. Provisional expense, not allowable or disallowable, which will also increase the taxable income. You'll have to 1,500,000 multiplied by 15% will give you 225,000, which will be definitely added onto taxable income. All right, these provisional tax payments are made in accordance with Section 99 of the Income Tax Act of 1959. Provisional tax may be paid by companies to ensure that income tax that is expected to be payable on their income in a particular financial year will be collected during that financial year. All right, let's proceed to the last question. Last transaction is prior year revenue lost in 2018, 3 million kina and 500,000 kina foreign, which is allowable income, but foreign loss is not allowable. This is an incentive income tax. Okay, the prior year revenue loss may be carried forward and offset against the current year profit for the tax purposes, subject to the provisions of the Income Tax Act, which could fall under Section 80 of the Income Tax Act. And that could bring the end of all this transaction incurred, and I hope you understand all this, and thank you very much, and that's all.